Welcome to the deep dive. Today, we're really getting into the weeds on mutual funds.
Yeah, it's a big topic.
It is. So our mission is to cut through some of that complexity in the source material, maybe uncover a few surprises, and just give you a clearer picture of the types, how they're managed, the taxes, which can be tricky, and, how to actually judge performance.
Exactly. It's pretty essential stuff for anyone investing or even just trying to understand their own portfolio better. We want to arm you with, let's say, the key insights to navigate this space.
Okay, so let's start with the sheer variety. People say mutual funds, but it's not one thing. The CIFSC, the Canadian Investment Fund Standards Committee, groups them. Well, all sorts of ways, right? Assets, risk.
Management style, too. It really is a huge ecosystem.
Right.
So at one end, maybe the simplest, you got money market funds.
The $10 share ones. Super safe.
Well, generally low risk, yes. They aim for that stable $10 value, focusing on liquidity, safety of principal. But, and this is important, they're not guaranteed like a GIC might be. And a little tax detail that catches people, those distributions. Always taxed as interest income, even the small amounts.
Good to know. Then, swinging completely the other way, you have equity funds.
Yeah, these are aiming for long-term growth, investing mostly in common shares, stocks. So naturally, much higher volatility usually.
And in between, or maybe a different category altogether, are target date funds. These are pretty clever.
They really are. The key concept is that glide path.
Explain that.
So the fund has a target date, maybe your retirement year. As that date gets closer, the fund automatically gradually shifts its investments. It moves from riskier assets like stocks towards safer ones like bonds.
All without you having to do anything.
Exactly. It just happens inside the fund. And you also mentioned asset allocation funds.
Right, briefly. Similar to balanced funds, but maybe more dynamic.
Yeah, that's a good way to put it. The manager has more leeway, sort of greater freedom to shift the mix between stocks, bonds, cash, whatever, based on what they think the market's doing.
Okay, so those are some types. But how are they run, this whole active versus passive thing?
Right, the two main styles. Passive management, or indexing, is all about just matching a market benchmark, like the S&P TSX Composite Index here in Canada.
Trying to be the market, not beat it.
Precisely. And the big advantage often comes down to cost. Index funds typically have much lower management fees.
And those lower fees compound over time, which can make a huge difference to your actual return.
A massive difference, potentially. It's a buy and hold, low-cost approach.
But then there's this closet indexing idea. What's that about?
Yes. This is where you have a fund that claims to be actively managed, aiming to outperform.
You're paying higher active management fees.
Exactly. But when you look under the hood, the manager is sticking really close to the index weightings anyway. They're not taking significant bets away from the benchmark.
So pay for active, getting passive-like results.
It can be frustrating for investors, for sure. Which brings us to another area that can trip people up.
Oh, yeah. This is often a surprise. You don't even have to sell your units to owe tax, right?
Correct. That's the first key thing. Funds buy and sell securities inside the portfolio throughout the year. If they realize gains or earn interest or dividends,
They have to distribute that income out to the unit holders. Right.
usually annually. And you get a T3 slip, sometimes a T5, showing taxable interest, dividends, and capital gains, even if you just reinvested it all automatically.
And the kicker. Capital losses within the fund generally can't be distributed out to you to offset your own gains.
Nope, they stay within the fund. So that's the first tax hit, annual distributions. The second is when you actually sell or redeem your units.
That's a disposition, triggering a capital gain or loss for you personally.
Correct. And 50% of your net capital gains get added to your income for the year. But here's the trap.
The adjusted cost base.
Exactly. Remember those distributions you received? Maybe reinvested, you already paid tax on that income. So you must add the amount of those reinvested distributions to your original purchase cost. That's your adjusted cost base, or ACB. Why? Because if you don't track it and just use your initial purchase price when you calculate your capital gain upon selling, you'll end up paying tax again on those reinvested amounts.
Double taxation on the same money. Ouch. So keep good records.
Absolutely crucial. Now, related to getting money out, what about systematic withdrawal plans for income?
Right, useful for retirement income. Fixed dollar, fixed period.
Yeah,
Different options to get regular cash flow without selling everything at once.
they offer convenience. But there's a significant risk, often called sequence of returns risk.
Meaning,
If the market drops after you start taking withdrawals, you're forced to sell more units at lower prices to get the same fixed dollar amount.
which depletes your capital much faster.
Potentially much faster. You could run out of money sooner than expected, especially if a bad market happens early in your withdrawal period.
Okay, so lots to consider. How do we measure how well a fund is actually doing then? Performance measurement.
It's key, right? You want to know if the manager is earning their fee? The standard disclaimer always applies, though.
Past performance is not indicative of future results. We hear it all the time.
And it's true. But looking at history can show trends, consistency, how a fund behaved in different markets. You usually compare it two ways.
Against its benchmark index.
Like the S&P TSX for a Canadian equity fund. See if it beat, matched, or lagged the market it invests in.
And against its peers.
Yeah, against a peer group of other funds with similar objectives. How did it stack up against the competition?
But comparisons aren't always perfect. You mentioned survivorship bias.
Right. Poorly performing funds often get merged away or closed down. So when you look at the average return for a category, it only includes the funds that survived. The average looks better than reality because the losers disappeared.
Skews the results upwards. And risk matters too, right? Comparing a conservative fund to an aggressive one isn't fair.
Exactly. That's where metrics beyond just return come in, like VD or volatility. How much did the fund's value swing up and down?
More swing means more risk, generally.
And beta is another useful one. It measures how sensitive the fund is to overall market movements.
So a beta 1 means it moves pretty much in line with the market.
Yep. A beta above 1, say 1.2, suggests it's historically been 20% more volatile than the market, amplifying both up and down moves. Below 1 means less volatile. It helps you gauge the type of ride you might be in for.
Okay, wow. We've covered a lot. The different types like money market, equity, target date, active versus passive management, and that closet indexing issue.
Then the really important tax stuff distributions, needing to track your ACB, withdrawal plan risks. And finally, how to actually measure performance using benchmarks, peers, and looking at risk metrics like volatility and beta.
So pulling it all together, with this deeper understanding, maybe the question for you, the listener, is, how will you now look at mutual funds? Will you go beyond just that advertised return number and really dig into the strategy, the real risks involved, and those tax implications that definitely impact your bottom line? Something to think about.